Ever wonder why Bitcoin rallies every time the Federal Reserve starts printing money and crashes when interest rates rise? It's not a coincidence. Crypto doesn't live in its own bubble. It's deeply connected to the global flow of capital. When liquidity floods the system, risk assets surge. When liquidity tightens, everything, from tech stocks to DeFi tokens, deflates. In other words, Bitcoin isn't just reacting to crypto news, it's reacting to the cost of money itself. Every major crypto cycle has mirrored global monetary trends. When central banks make money cheap, capital looks for yield and finds it in crypto. When they tighten, that easy money disappears. In this video, we'll break down how interest rates, liquidity, and macroeconomic policy quietly shape every move in the crypto market, and how professional investors anticipate these shifts long before the charts reflect them. Most crypto investors still treat the market like an isolated universe, driven by halving events, token launches, and viral narratives. But these are surface-level ripples. The real force moving the tide is global liquidity. Every dollar that enters or exits the system affects risk appetite worldwide. When interest rates rise, borrowing costs increase, credit contracts and liquidity dries up, pulling capital out of speculative assets like Bitcoin and altcoins. When rates fall, liquidity expands, and money floods back into markets chasing higher returns. We saw this play out vividly between 2020 and 2022. In 2020, central banks slashed rates to near zero and injected trillions into the economy through quantitative easing. That liquidity overflow didn't just lift stocks, it fueled one of crypto's most explosive bull runs. Bitcoin rocketed from under $10,000 to nearly $69,000 in a year as global liquidity surged. But when the Federal Reserve began its aggressive tightening cycle in 2022, draining liquidity to fight inflation, the market reversed. Bitcoin collapsed below $20,000, and liquidity-dependent projects across DeFi and NFTs imploded. The lesson is simple but crucial. Crypto is a liquidity sponge. It expands when money is abundant and contracts when liquidity disappears. The traders who understand this don't chase hype. They track liquidity. Because in the end, price follows flow. Interest rates are the heartbeat of global capital. They determine how expensive or cheap money is to borrow. When central banks raise rates, they're essentially increasing the price of money, making credit more expensive. This slows down economic activity, reduces leverage, and pushes investors towards safer, yield-bearing assets like government bonds. When rates drop, borrowing becomes cheaper, liquidity expands, and investors hunt for higher returns in riskier assets, like equities, venture capital, and crypto. In traditional finance, this dynamic has been understood for decades. When rates are low, capital moves out on the risk curve. When they're high, it retreats to safety. Crypto behaves no differently. For example, during 2020 to 2021, when interest rates were near zero and global liquidity hit record highs, Bitcoin and Ethereum both surged as investors looked beyond bonds and savings accounts for yield. The cost of capital was minimal, so speculative assets thrived. Contrast that with 2022, when the Federal Reserve raised rates at the fastest pace in decades to combat inflation. Yields on U.S. Treasuries rose sharply, giving investors a risk-free alternative. As a result, liquidity exited speculative markets. Bitcoin, Ethereum, and most altcoins saw massive drawdowns, not because their fundamentals vanished overnight, but because liquidity did. The takeaway: crypto doesn't rise and fall randomly. It moves with the global flow of capital. Rising rates tighten liquidity and drain speculative energy. Falling rates loosen liquidity and reignite risk-taking. Smart investors track rate trends, not tweets, because monetary policy is the invisible hand guiding every crypto cycle. Liquidity is the lifeblood of every market. It represents how much money is available and how easily that money moves through the system. In crypto, liquidity determines how much capital is chasing assets, how stable prices remain, and how deep market moves can go. A liquid environment means there's plenty of cash, confidence, and credit in the system. A dry environment means fear, hoarding, and forced selling. Global liquidity doesn't just come from one country or one central bank. It's a network, the combined effect of money supply, credit creation, and central bank policies across the world. For instance, when the U.S. Federal Reserve, European Central Bank, and Bank of Japan expand their balance sheets, liquidity increases globally. That's why even if one region is tightening, another injecting liquidity can offset the impact. We saw this in early 2023, when global liquidity began quietly improving despite the Fed's ongoing rate hikes. Central banks in China and Japan were adding liquidity to stimulate their economies, and the overall global liquidity index began to turn upward. Almost immediately, crypto prices rebounded. Bitcoin climbed from around $16,000 to over $30,000, even before any major shift in U.S. policy. That's because crypto doesn't care where the liquidity comes from. It simply reacts to the aggregate global flow of capital. Think of it this way. Liquidity is the oxygen of financial markets. When there's plenty of it, assets can breathe, expand, and grow. When it's cut off, even fundamentally strong projects start to suffocate. This is why macro-focused investors monitor global liquidity indicators. Because before prices rise, liquidity moves first. Crypto doesn't just respond to liquidity, it magnifies it. When global liquidity expands, risk appetite soars, leverage increases, and speculative behavior explodes across the market. This is when narratives like DeFi in 2020, NFTs in 2021, or AI tokens in 2024 catch fire and drive exponential rallies. Liquidity acts like rocket fuel. It doesn't create new ideas, but it allows existing ones to take off. During high liquidity phases, investors are more willing to take risks, fund new projects, and lock capital into yield strategies. The result is a flywheel effect. Rising prices attract new capital, which increases liquidity even further, sustaining the uptrend. For example, in 2021, after trillions of dollars in stimulus flooded the global economy, Bitcoin, Ethereum, and even meme tokens like Dogecoin experienced parabolic moves. The surge wasn't just about technology or adoption. It was about abundant liquidity searching for returns. But the reverse is equally powerful. When liquidity tightens, leverage unwinds violently. Projects dependent on speculative inflows lose funding, token prices collapse, and even strong assets face sell-offs. The 2022 bear market was a perfect case study. As the Federal Reserve drained liquidity through rate hikes and balance sheet reduction, crypto's total market capitalization fell by over $2 trillion. The key insight is that crypto leads liquidity, but also exaggerates it. Because digital assets trade globally and are highly reflexive, they tend to react to liquidity changes before traditional markets do. When liquidity bottoms and starts to turn upward, crypto is usually the first to rally, often months before macro indicators confirm the shift. Understanding liquidity is powerful, but tracking it in real time is what separates casual traders from macro-aware investors. There are a few key indicators that reveal whether capital is entering or leaving global markets, and by extension, crypto. First, watch central bank balance sheets. When the Federal Reserve or other major banks expand their balance sheets, it means they're adding liquidity, often through quantitative easing or asset purchases. An expanding balance sheet has historically aligned with Bitcoin bull runs. Conversely, when these balance sheets contract, quantitative tightening, liquidity is being withdrawn, and risk assets suffer. Second, monitor the US dollar index, DXY. The dollar is the world's reserve currency, so when it strengthens, global liquidity tightens. A rising DXY usually signals capital fleeing to safety. Bad news for crypto. A falling DXY, on the other hand, means global liquidity is loosening, which often precedes crypto rallies. Third, track real yields, which are interest rates adjusted for inflation. When real yields rise, investors prefer safer government bonds since they offer positive returns without risk, pulling capital out of speculative markets. When real yields fall or turn negative, investors hunt for alternatives like crypto to preserve purchasing power. Within crypto itself, stablecoin market caps are a leading liquidity signal. When USDT or USDC supplies expand, it often indicates fresh capital entering the ecosystem. Similarly, rising DeFi total value locked, TVL, shows liquidity deployment, not just on paper, but in active yield strategies. Lastly, global M2 money supply growth, the broadest measure of money in circulation, tends to move in tandem with crypto market capitalization. When M2 expands, liquidity increases. When it contracts, liquidity tightens. Crypto doesn't exist in a vacuum. It's a reflection of global liquidity and interest rate cycles. When money is cheap and abundant, capital floods into risk assets and crypto rallies. When liquidity tightens, capital retreats and prices drop. The smartest investors aren't chasing hype. They're tracking these flows, reading the macro signals that precede every major move. By monitoring indicators like central bank balance sheets, the US dollar index, real yields, stablecoin supply, and TVL, you can anticipate when liquidity is entering or leaving the market. These metrics give you an edge over traders who only follow price charts or headlines. In the end, understanding crypto means understanding where the money comes from and where it's going. Because no matter how innovative a project is, it can only thrive if global capital allows it. Track liquidity, follow the flow, and you'll know when the next wave of crypto opportunity is about to hit.